Thank you for joining us for a seminar on legacy giving and specifically exciting news about how to use the government's money to direct to the kingdom. So just a recap of Liberty Counsel's mission so that you are aware of everything that we do is going to be viewed through this grid. Does it advance religious freedom? Does it advance or protect the sanctity of human life? And does it protect and advance the family? And of course, we mean traditional family. For many years, many of the laws that we have seen implemented have come into law, or more specifically, court rulings, because we as Christians were not even in the fight. Judges and Supreme Court, all the way down to appellate level, have made decisions such as abortion, for example, that were passed into our laws, and we as God's followers did not even show up at the fight. So part of the mission and part of the reason that Liberty Counsel has entered is the concept indicated in this verse from Isaiah, that the Lord looked and was displeased that there was no justice. He saw that there was no one, and he was appalled that no one intervened. So our role at Liberty Counsel is to intervene. And of course, we cannot control what the judges do, but we have seen great victory when we have showed up. Very often we win. And just like missionaries, some are called to actually go, in this case, the courtroom. Others are called to support that mission financially. And again, we thank you for your support that you're already giving to Liberty Counsel, because we cannot go without your support. So this conference, this seminar is about traditional IRAs and specifically how to give more efficiently using this wonderful retirement tool. So first, just to go through exactly what it is, give some definitions and some key ages so that we have clarity on different ways that we can approach this. One of the big advantages and attractions of a traditional IRA is that the investment grows tax-free until they're withdrawn. So all of the contributions are not taxed when they go in. The only way to fund a traditional IRA is through payroll deductions. So that means as you're contributing to the IRA, then it lowers your taxable income. Now, some key dates to remember. Before the age of 59 and a half, if you withdraw from this account, not only will you have the income tax, but you will also realize a 10% penalty for early withdrawal. After the age of 59 and a half, it's still subject to income tax, but we do away with the 10% penalty. Now, and another important date when it comes to these types of investments is age 73, where you get into the age of required minimum distributions. Basically, what that translates to is that the government is requiring you to take a withdrawal from your traditional IRA, whether you want to or not, because they want the income tax. So it goes, you take it into your checking account typically, or your savings or money market, and you are required to pay. It goes right into your taxable income. So what we want to discuss is if we can be more efficient and utilize those resources for the sake of the kingdom, instead of sending it to the government so they can use it for their favorite charities, we would rather you use it for yours. And certainly the laws that are on the books, as we know them right now, absolutely allow you to do that. So all withdrawals are subject to income tax. So it could be that you take them during your lifetime. It could be that upon your death, your spouse survives you and they can roll it over to themselves, but all others must take the value of the inherited IRA at your death. They must completely empty that separate account. It needs to be separated within 10 years and pay any income tax due. Whoever receives that is who is going to pay the income tax. And a key note, just to avoid confusion, these rules do not apply to Roth IRAs. They do not have RMDs or required minimum distributions. Only the traditional ones do. And where this becomes important is, as with many things, the House rigs the table, and in this case, the government is the House. So they're counting on the average age of death to be about 83.3, is according to the IRS's tables, which means most of us, when we reach that age and these RMDs, these accounts go to our children or our other beneficiaries, they are likely going to be in their 50s and 60s, which is their high earning years. So whatever is in your IRA is now being added to their taxable income, and therefore in most cases is going to be taxed at the higher income tax rates. And speaking of the income tax rates, for single filers, there is a range. There are more tax brackets, but I didn't want to overwhelm you with all of them. So for a fair range for what's going to affect most of us, you can anticipate 24 to 37% taxes depending on what your income is. And again, why this is important, for example, if let's say your beneficiary averages an income of $150,000 and then they inherit your traditional IRA, now you've just potentially bumped them up to the next tax bracket and move them from 24% tax to 35% tax. So you can see how this is significant to be aware of the tax implications of the income tax of these accounts. For married filers, the numbers change, and again, 24 to 37%, but beginning at 211,000, then it goes up dramatically. The important part of this is that everyone is a philanthropist, meaning that you cannot take it with you. You are giving it away. So what we're talking about is how to give it in a way that goes to enforce your values and further the causes that you care about, instead of giving them to the government and it going to their favorite causes. Most people are unaware that this tax bomb, commonly known as the traditional retirement account, at a range of 24 to 37%, is going to explode in the face of our children, because most of us don't need the money, don't want the money, and are only taking it because the government is forcing us to. So when you're giving it away, let's give it to your favorite causes instead of the government's. Life is not a marathon. We do not run this alone. It is a relay race, and we are holders of our assets only during our lifetime. And good stewardship means that we also think about the next generations and be good stewards of God's resources while we have them, but also thinking generationally to the next stewards. You will leave a legacy. Sometimes it's a good one, sometimes it's a bad one, but everybody leaves a legacy. And it's easy, even the title of this, legacy giving, our minds quickly go to only the money. But legacy, as we pass the baton to future generations, includes a lot more things. We want them to know what our beliefs are, what's important to us, the value of our family, the value of our church, the value of the ministries that we support. And it includes not only the results of our past actions, but also the future. Because what we do today will echo in eternity. So we want to be mindful of our actions, where we invest our money, what we give to, and the message that that sends to our beneficiaries, and also supporting those missionaries, those ministries. If maybe our beneficiaries would not support the things that are important to us, we have opportunity to do that by where we give our resources. So the good news is you do have the option. You can choose to give this traditional IRA to the kingdom instead of to the government. The better news is that for the charity that receive it, it is totally 100% tax-free. So you are literally using the government's money, that money that otherwise would have gone to the government, and you can redirect it to the kingdom, to your favorite causes and your favorite ministries. Not only will it help advance the things that are important to you, but it will also leave a legacy and a testimony to your beneficiaries and all who know about it to what's important to you. The way you leave a legacy, there's a few different ways. One is at death. The one that most people are familiar with is leaving a bequest in your will. Now, this is certainly good, so we don't mean to knock that, but there are a lot of things that may affect that you may not be thinking of. One, that your will or your trust could be subject to taxes. Another is that your will and trust might be going through some sort of administrative process and also are subject to your creditors' claims before your charities get what is left over, or what would be called the remainder. Other things that can avoid all of that and make sure that 100% goes directly to the things that are important to you is your retirement plans. You're able to list your charity for all or maybe part of your retirement accounts. Charities receive these funds tax-free and also free of creditors and free of probate. Another method that some people use is on bank or investments account. You can designate those accounts with a pay on death or transfer on death designation, and that lets the bank or investment company put those assets directly to your named charities or your children, wherever you choose to give it. Again, also not part of the administrative process. Also, life insurance. Life insurance is tax-free, so I want to make sure clarity there. But if you want to make sure that all or part of your life insurance goes directly to beneficiaries, to include charities, then you can name that as beneficiaries of your life insurance. Another way to do legacy giving and to think during your lifetime to get the tax benefits of it is to give appreciated securities. That would avoid capital gains. That would include real estate, also subject to capital gains. But also what we're talking about here is out of your traditional IRAs. And we talked about the different dates that are important, and we'll talk about those in a little bit more detail very shortly. But not only can you not pay income tax on anything that you direct from your traditional IRA, but also it is tax efficient, because if you were to give out of your checking account, you're only able to deduct 60% if you itemize at all. If you don't itemize, then you get no tax benefit, and you are taking your traditional IRA as taxable income, or your kids or other beneficiaries are. So one of the options that you can use to avoid this is a qualified charitable distribution, or a QCD. The way it works is you give directions to the custodian of your traditional retirement account, instructions to give that donation directly to your charity. You cannot put it in your checking account and then write a check. You will not get the same benefit. It must go directly from your traditional retirement account to your named charities. It is allowed at age 70 and a half, but also it satisfies your required minimum distribution, which kicks in at age 73. So instead of you taking the distribution, which for many of us we don't want anyway, you can have it go directly from your IRA to your charity through this qualified charitable distribution. It's never reported as income to you. And as you can see, this is not just for the uber wealthy. This is not something only for the Rockefellers and the Kennedys, but this applies to all of us who have retirement accounts. Now, for those of you that are high income earners, if you lower your adjusted gross income by using this method, then it would also affect what we affectionately call IRMA, which is what sets your Medicare premiums, and that's all based on your adjusted gross income. So if your income is lower, then potentially you could be paying less in Medicare premiums. So here are some examples to show you with and without the qualified charitable distribution so that you can see how this works plugging in real numbers. Your required minimum distribution is established December 31 of the previous year. So let's say for our example that we have a person who is 75 years old and they have $500,000 in their traditional retirement account. So at today's numbers, the government would require them to take $20,325 as income, whether they wanted to take it or not. So assuming that they fall kind of in the middle, a 32% income tax bracket, that would result in $6,500 of that $20,325 being subject to and paid in taxes. So the net to that person after tax is only $13,825. And again, a note that the Roth is not subject to RMDs. So what we find a lot of people are doing is they're taking the required minimum distribution because they have to, and now it's countable as income. And then at the same time, they are writing a check out of their checking account to support their favorite charities. So in essence, that's double taxation. One, they're paying income tax here, and then they're also using after-tax dollars to make the charitable gift. So this is a lot more efficient. You could effectively give that $20,325 to your favorite charity, and 100% goes tax-free, and your charity gets the benefit of the full $20,325 instead of the net after taxes are paid. So to show you how this works, if instead this person gives directly to the charity through using a qualified charitable distribution, the full $20,325 would go to the charity directly from the custodian instead of the net, and they can give all of it or part of it, whatever they wish. The tax impact would be the same as to you, but you see a much greater impact to your charity. So why do we do all this? Not just because it's about money, but where you spend your treasure shows where your heart is, and Scripture is very clear in its admonition to store up your treasures in heaven, and we want to be wise stewards of what God has blessed us with and use the existing laws to give in a way that's more efficient. And if the laws allow us to give directly to our charities instead of passing it through the government first, we absolutely should take advantage of these laws and follow these laws. But we have found that a lot of people who are faithfully supporting us, which we very much appreciate, are doing after tax and in many cases paying double tax, and they're not aware that they can give it directly this way. So if you want to find out more about other estate planning tools, other things that you should be interested in, we have many free resources available on our website, lcgiving.org. And you can also follow that QR code, which will lead you to our website. Those are all available to you. We have a letter of hope, which you can use in your healthcare directives. We have a memorial planner. Great stewardship is to tell your kids what you want to happen upon your death so that they're not wondering what to do. We have a Christian will introduction so that you can leave a testimony in your last document. Your last testimony, if you will, can be in your will. Thank you so much for joining us. And if you have any needs in the future, you have our phone number and website. Feel free to contact us, and we would be happy to help you with your legacy giving needs. God bless you.